Welcome, and thank you for your attendance. We would like to present you the results of our research on KGHM Polska Miedź S.A. First, let me introduce all team members. Marta, Katarzyna, Kamil, Jan, and myself, Piotr. KGHM is a Polish copper producer. The company extracts copper ore from its own resource base and processes it further into the refined form. The final products are mainly used in energy and telecom sectors. The company is one of the biggest and most liquid blue chips on Warsaw Stock Exchange, with average daily traded value of $40.6 million. We issue a buy recommendation for KGHM with a 12-month target price of 220 Polish zloty, offering almost 19% of upside potential from current price. We identify following main growth drivers: robust pipeline of new projects, increasing operational efficiency, stable copper market conditions, and sound financial position. KGHM was established in 1961 by the Polish State Treasury, which has remained the controlling shareholder. Since inception, the company gained experience and local recognition. However, the recent acquisition of Canadian Quadra FNX was a true milestone in the history of the company, making KGHM the 9th biggest firm in the industry as far as the production volume is concerned. The favorable conditions of the transaction are limiting the risk of the acquisition to succeed. New projects are expanding current operations of the company to countries like the USA, Canada, and Chile. The acquired open pit mines are a main factor for efficiency improvement due to lower extraction costs. As shown in the EBITDA contribution graph, foreign operations will have increasing importance in the close future.
Let me describe now the copper market. It is characterized by high entry barriers, low product differentiation, lack of copper perfect substitutes, and the fact that individual copper producer is a price taker. Let's focus on the most important factor, copper prices. Copper market, similar to KGHM, expands to new markets to satisfy demand and keep prices stable. Up to 2025, the demand growth is expected to even exceed the compound annual growth rate reported in the last 20 years. Nevertheless, high copper prices made it profitable for companies to engage in new projects and, in effect, increase global supply. Although, according to World Bank estimates, copper prices are expected to decrease by 15% until 2025, the predicted long-term copper price will stay well above KGHM cash extraction cost. Apart from fundamentals, short-term copper price increase is possible due to new round of quantitative easing on the US market. Expansion strategy was followed by KGHM, which acquired Quadra, therefore increased its resource base and strengthened market position. If we compare KGHM to its chosen competitors from and outside of top 10, we find out that the company presents the best quality of ore, net income margin higher than the group's median, and persistently higher than equity.
Now we shall step to financial analysis. Due to acquisition of Quadra, KGHM gained new resource base. Development of new projects will require significant capital outlays, but they will translate into high production. We estimate a 58% increase in production volume between years 2011 and 2017. Additionally, new projects have lower extraction costs, which will enable the company to improve its profitability. We forecast EBITDA margin to rise from 35% in 2012 to 45% in 2017. KGHM is expected to internally generate sufficient amount of cash to both invest in anticipated projects and to maintain attractive dividend policy. Currently, the company has the lowest debt ratios among mining peers, and net debt to EBITDA ratio is forecast to stay at low levels. Due to high debt capacity, good interest coverage and solvency ratios, KGHM is going to be able to easily incur more debt if needed for new acquisitions or growth projects without high costs. Historically, KGHM showed very appealing policy regarding dividends, with median dividend yield in the last 5 years equal to 11%. We expect that this policy will not change in the future and estimate the median value of dividends for the next 5 years at almost 17 zlotys per share. Additionally, dividend payouts are forecast to be at substantially high levels as compared to the average of peers.
Now we begin valuation part, starting with market pricing. For meaningful comparison purposes, we place KGHM among 5 industry leaders, which derive at least 75% of revenues from copper sales, have similar size and business profile. Our calculations are then based on peers' median P2E and EV to EBITDA for 2 years forward and equally weighted. The price obtained in this way equals 247 zlotys. However, there is a long-term discount observed on KGHM multiples in relation to its peers. We consider this situation to be justified in the past because of higher KGHM systematic risk, lower opportunities for growth, lower multiples on average for Warsaw Stock Exchange, and the ambiguous impact of the state treasury being the major shareholder. The business environment of the company, however, has changed significantly at the beginning of 2012. Looking forward, diversification should reduce the risk, and together with projects in pipeline, it makes first 2 points no longer valid. On the other hand, we do not expect multiples for our exchange to increase sharply or the state treasury to diminish its ownership stake in the company. Additionally, based on our research, the government presence in the shareholder structure may negatively influence pricing of domestic companies as they currently trade at 20% discount to their international peers. Hence, despite outstanding growth opportunities for KGHM, we assigned 25 and 20% discounts for years 2013 and 2014 respectively, the same for both multiples. The adjusted price is then equal to 192, and we consider it to be more reliable than the previous one.
In the DCF valuation part, we found the following factors the most important. Main revenue drivers, copper and silver prices, are expected to decrease. Introduction of mineral extraction tax, which is included in cost of goods sold and not tax deductible, immediately affects gross profit and effective tax rate. These are the main reasons of profit margin deterioration. Weighted average cost of capital is decreasing too, due to lowering risk and changing capital structure. The discounted cash flow analysis led us to the fair value of 248 Polish zlotys, combining 2 valuation approaches. We obtained a fair value of 220, offering almost 19% of upside potential. Now, let's move to the risk analysis. I'd like to focus on risks which are characterized by both high probability and severe impact on KGHM's price. First, the influence of state treasury, which may affect certain strategic decisions such as investments, acquisitions, and dividend policy. Second, the risk of increase in production cost. Thanks to acquisition of Quadra, the average group production cost is going to decrease. Also, new cost-efficient technology is being developed. And finally, fluctuation of copper and silver prices and exchange rate, because they have the biggest influence on revenue. We investigated their impact on KGHM's price in details using Monte Carlo analysis. As you can see, 75% of outcomes lays to the right from current price level, which suggests limited downside risk. Additionally, in previous years, management proved successful in hedging its positions.
Concluding, we recommend to buy KGHM. Development projects are going to significantly increase the production volume and improve the operational efficiency. We believe that the company will be able to internally generate sufficient amount of cash and sustain attractive dividends. However, investors should pay particular attention to following events: publication of new strategy in mid-2013, positive updates on current mines under construction status, or new M&A opportunities. Thank you for your attention. We may now answer your questions.